Good afternoon, everyone, and welcome to the year-end commercial real estate review and outlook hosted by RealNex. I'm Jeff Finn, CEO of RealNex, and once again joined by Dr. Jeffrey Fisher, our head of data and research. We have another outstanding program with a tremendous amount of information to share based on Jeff's work and findings with the research he's done with the NCREIF index and other research that he's done, and we will start in just a minute. But as everyone's joining the room, got a quick little intro video we'll play to introduce you to RealNex once again, and come back to you and get started with the program.
Business as usual isn't good enough anymore. The future belongs to the technology-advantaged power broker. Power brokers get more deals done faster with RealNex, the most complete commercial real estate technology solution for fast lead generation, complete financial analysis, beautiful presentations, stimulating marketing, and successful deal management. With RealNex, power brokers quickly profile people and properties to most efficiently prospect for new business, manage deals, and report on activity. No one knows the market better than a RealNex power broker. They have complete data on market inventory, comparable sales and leases, hidden spaces, and the most active buyers, sellers, and tenants. They efficiently collaborate with clients using the RealNex Tourbook leasing app and run accelerated sales processes in private and secure deal rooms. Power brokers eliminate redundancies and save time with automated investment and comparative lease analyses, and they swiftly create an incredible array of professional, elegant, and consistently branded marketing materials. When it's time to go to market, a RealNex power broker can economically run highly targeted e-marketing campaigns to their private prospect lists, or instantly tap into the vast RealNex community to assure no stone is left unturned. Power brokers can even leverage 3D virtual reality to improve deal cycle times for buildings and spaces, and instantly assure clients the space works perfectly for them. Power brokers effortlessly impress their clients to instantly save more time and make more money. The future is now. You too can be a power broker. Boost your results. Sign up for RealNex today.
All right, welcome once again. Appreciate your joining us today. I know many of you are already taking full advantage of the RealNex platform, or at least some advantage, and look forward to more of you learning about how you can tap into the tools and resources that we have to share. Please do check us out at realnex.com, sign up for a demo, or talk to one of our representatives, and we will make sure you are able to see the full value of the platform. But in the meantime, once again, we are joined by Dr. Jeff Fisher. We are at an interesting point in the cycle, once again, in an election year, the beginning of a year, and I'm going to turn the session over to Jeff. He's got a lot of interesting remarks to share. We have a question box on the right of the screen. As we go through the program, we'll have a couple of polls. We ask you to join in and share your thoughts and perspective on the market and where you're seeing things. And if you have questions to pose, please put them into the box and we will tee them up at the back end of the program. But for now, let's get started. Jeff, looks like you are set and ready to go. So take it away.
Thank you, Jeff. I assume you can see my screen.
You got it.
Okay, Jeff said this will be a year-end commercial real estate review and to some extent an outlook. I had the pleasure of doing this webinar with similar slides last week for NCREIF, the National Council of Real Estate Investment Fiduciaries, where I was joined by Michael Cohen with Costar and Matt Mao, who's with Oxford Economics, and actually learned a lot from them in terms of what their outlook is, and some drill down by property type, and so I'm going to share some of that with you along with the slides that I typically show from the NCREIF data, which is the data from institutional investors, about $500 billion of real estate, all the main property types held by the institutional investors around the country, with contributors like Morgan Stanley and JP Morgan and Prudential and Deutsche Bank, et cetera, et cetera. So I'm going to start off with some economic indicators, which I haven't done in the past, but I think it's a good time as we're moving into a new year to sort of see where we're at. And of course, what's happening at the macro level for the economy does impact commercial real estate at some point. So see here kind of a summary of GDP growth, treasuries, and inflation. And you can see the GDP growth is expected to be a little bit slower in 2020. This actually came from CBRE research. I've also gone out and kind of looked around the internet and at the different research sites to see what folks like CBRE and Prudential, PGIM now, and USAA Realty and others, are saying in their research reports. So I could hopefully pull together a little story here as to what's going on. So I think pretty much of a consensus that things are going to be slower in 2020, but still 1.5% to 2% GDP growth. So certainly nothing like a recession that anybody sees. And actually, you'll see in a chart that I'll get to next that the GDP growth may actually be higher than starting in 2021. Treasuries may go up a little bit, although I'll show in a later chart that actually short-term rates are projected to fall even more. So not a big change in interest rates, and really no change projected for inflation. Actually, the Fed would like to see higher rates of inflation, but seems like we're kind of stuck. Maybe it's good at the relatively low inflation rates. I say maybe good because real estate has always actually done very well in an inflationary environment, so we're not really too concerned about inflation picking up. Although we do have to be concerned a little bit about cap rates going up. So a little closer look at the GDP growth projections. Again, you see kind of what it's been historically, but then for 2020, you see that drop off, but then coming back in 2021, 22, and 23. So I think if that holds, we're going to be pretty happy. One of the reasons for the drop this year is the coronavirus. There is concerns that that's going to shave 25 basis points or more off of global growth. And as compared to SARS, some of you may remember, that also started in China, and that caused a 15 basis point impact. So basically extrapolating from that, the economists, in this case at Oxford Economics, I think we're probably going to shave about 25 basis points off of global growth. As somebody said, if China sneezes, the whole world catches a cold, and it is going to impact all of us. Hopefully not too bad, but it is kind of sad to see what's happening with that virus. So the labor market is expected to cool a little bit. You see the forecast down a little bit. And my spell checker didn't like the way we normally spell labor market, so I've got the OUR. Labor market is expected to be still expanding, but unemployment continuing to be at a low level. And although hiring this year is likely to slow down a little bit. I don't have a chart with the PMI number, but one of the reasons the stock market is down today, 266 points, as I see now, because the purchasing management index was down, that just came out this morning, which is related to the same economic factors that we're talking about here. So weaker job growth, could translate into weaker consumer spending. So the consumers may pull back a little bit in 2020, but again, no concerns about extreme drops. We're just, I think, things kind of slowing down, which is, as we get to the returns for real estate, I think same idea, just a little bit lower return levels than we've had historically, but nobody's, as of yet anyway, seeing any significant drops in values and returns. And one of the reasons for that would be there's still an abundance of capital out there. As you can see here, the volume of capital is expected to be just about as high in 2020 as a forecast as we've had in 2019. So pretty much at you know, I don't know if we can say historic high levels, but certainly the highest level since 2007. And we also have a lot of debt capital that's still out there. You see a projection here of the commercial real estate debt on the right-hand chart. And I've talked in the past about the difference between the core and value add funds, the core being the low risk kind of funds that a lot of the pension funds invest in. And the value add is more properties that have lease up opportunities, maybe a little bit of development in their higher leverage. And you can see that plenty of debt capital for those higher risk value add funds, and also for construction. In fact, you see the increase that we've had since 2015 in the capital that's been available for all these, but the most significant increase has been for construction. So the outlook for interest rates, against dropping slightly, the red line, the federal funds rate, short-term rates dropping a little bit more, 10-year treasuries just up a little bit. And I might mention that interest rates in the US are still way higher than they are in I think most other countries around the world. So there is room for interest rates in the US to get down, although it's hard to imagine they'll go down much. And again, the forecast here is actually for just a slight increase in the 10-year treasury yield. Although I think with the PMI report that came out this morning, the rates actually dropped a little bit today. Home ownership rate is tracking up since about 2016. I was actually surprised when I looked at this that it took so long since the recession in 2008, 2009 to have the home ownership rate start to go back up again. We certainly have a long way to go compared to the peak. I don't know if we'll ever hit the peak level that we had. Maybe we shouldn't hit the peak level that we had in 2004, 2005. But it is good that the home ownership rate is going up, although from everything I'm hearing, there's still strong demand for apartments in terms of projections out 10 years or more. The industrial demand is slowing, which affects demand for warehouse space to some extent, although as we'll see on some later slides, when you look at what's happening with the e-commerce, still a strong demand for warehouse space, especially the smaller space by Amazon and other e-tailers. So now going to the NCREIF Property Index, NPI returns. It's actually been remarkable how stable the returns have been since, on this chart, 2016 second quarter. Haven't had a lot of volatility in returns like we historically have had. And we were actually up for the fourth quarter of 2019. So up from the third quarter of 2019 and up from the fourth quarter of 2018. So we really did end the year on an upbeat. Which was actually, I was kind of surprised at that. More general, again, way to look at it might be that things have been pretty stable over recent years. So let's see what you all think. We're at, let me go back to this one, we're at about 1.5%. I'll remind you, this is quarterly unleveraged. If you're looking at that and saying, wow, that's a pretty low rate of return, that's a quarterly return. Unlevered, so not taking into consideration that you could borrow money, at hopefully a lower rate. And so we're talking about 6%, a little bit over 6% on an annual basis. So where do you all think we're going to be on average for 2020? Do you think we'll be in that 6% range still, which would be C, 4 to 8%, or even higher? Or are we going to drop down and have lower returns, 0 to 4, hopefully not below 0? Always interesting to see what the participants think. You guys are out there doing deals, and so you kind of know how that might impact values and rent levels and everything that goes into those returns.
All right, well, let's close down the poll. Let's see what we've got.
Yeah, and I don't think I see them, Jeff, so you'll have to read them off.
Here we go. So the results are 44% believe the returns will be between 0 and 4%, and 56 between 4 and 8. So a little bit wider bands than we've had in the past, but no one's at the either end of the spectrum, which is interesting. So no
Yeah,
one's thinking.
so a little bit more to the downside, but still positive rates of return.
Yep.
So that's good. That's pretty consistent with what we saw from the institutional investors when they participated in similar polling questions. These are the components of the return I've shown you before. For those that have been to previous webinars, this breaks down where the return is coming from into the cash yield, the NOI growth, cap rate changes. I think what's important here is that the red is just about gone, which is the bump in returns that we got from cap rate compression, from cap rates dropping, with interest rates, at pretty all-time low levels, and cap rates certainly at all-time low levels. Hard to imagine cap rates going down much more to help the returns, although again, interest rates in the US are higher than other countries, so who knows? We keep seeing tiny drops in cap rates from quarter to quarter. Actually had a little bit of a drop this last quarter. But what's going to be most important is the NOI growth, which has been good on properties, and the cash yield that we get. So the combination of current income plus the growth in rent levels, and that leading to NOI growth. Another way to look at pricing is to compare the cap rates on real estate. In this case, we're starting at 1999. You can see pretty much the constant drop, except for the years of the recession when real estate was repriced, risk premium added in, and we had the increase in the blue line there, but then steadily decreasing since then. They really line up very closely with those BAAA yields, the measure of the longer term, a little bit riskier bonds. So to some extent, we can kind of say if 10-year treasuries, which would also be a long-term rate, if those are going to kind of be steady or increase a little bit, we might have cap rates steady to increasing slightly. You can see here the cap rate spread over the 10 years, and in this case, actually that premium over the 10 years has increased recently, so that's good. We got the margin for cap rates still staying the same, even if the treasury rate goes up a little bit. And we also we can see here the spread across the different property types, with industrial still being near the high in this chart, which is kind of surprising given the strength in industrial and the returns that we've seen. Multifamily always tends to be at the low end. And you can see we're at the low end. There's a dot on each of these graphs at the very bottom, which is where we were in this case, the third quarter 2019, but it's the same with the fourth quarter, really at the bottom of the long-term range for what we've had in cap rates for all the different property types. So where do you think cap rates are going to be for 2020? You think we're going to stay I think we're actually averaging all the property types together at about 4.5% right now. So is it more likely to be a little bit lower in the 4 to 4.5% range, or a little bit higher, 4.5 to 5? Or does anybody think it could actually go above 5? And it certainly has historically been at levels way above 5. Or could we even go below 4? And think of this as more for institutional real estate, with it being a little bit higher for the non-institutional real estate. They all move together in terms of cap rates over time, just more the level of the cap rate.
I was on mute. Let's wrap it up. I'll share the result. There is no ultra bull out there. No one thinking we're going below 4%, but 16% are in that 4 to 5% band. The vast majority at 59% at 4.5 to 5%, and then 25% expected to jump back up above 5%.
Okay, that would probably be a pretty significant increase in interest rates, about 50 basis points, but could happen. This is another way of looking at not only the cap rates, but what the value is of all the properties, in this case, in the NCREIF database, that $500 billion of properties you can see indexed going back to when the index actually started back in the beginning of 1979. You can see it's like if you invested $100 then, you'd be up to $365 on the red line, which is the market values. And then the net operating income, if you index that, if you index $100 of net operating income, we'd be up to 265 roughly of guess a little bit higher than that of net operating income. The reason the red line went up faster to a higher level than the green line, they started at the same point, is because of the cap rate compression. Investors were willing to pay more for the same net operating income starting in, as you can see here, around 2010. We've had that cap rate compression, which has boosted up the values as those cap rates came down. So we did have a all-time high in values at the end of 2019. The question is, what's going to happen in 2020, which is our next question. We've got several questions kind of here all at once. When do you think the market will peak? Did it peak in the fourth quarter of 2019? Or will it be the first quarter of 2020, or sometime after the first quarter, but in 2020? Or are we going to be able to push it down the road even further? And Jeff, I know you usually summarize these and send it out to everybody. So don't worry about writing down the results. We'll make those available. It's always interesting to see the sentiment of the participants.
We'll definitely get the results out the first of next week. The full deck and the recording will come out. But for anybody wanting the early polling results, we will share them with you now. Here we go. So 3% feel they have, or they did peak the end of 2019. 18% are expecting this quarter to be the peak. The majority at 45% expect it to be later this year, and 33%, which is still a significant number, are looking for 2020 or beyond 2020 to be the peak. So we're still
interesting. Yeah, very consistent with what we saw from the institutional investors.
When you look at that chart, it certainly seems to be heading in that direction still.
Yeah, good. So now a little bit of a breakdown by property type. You can see the vast difference we have between industrial and retail. I showed you a graph earlier that was the returns when you combine all these property types together, and I kept saying how remarkably stable it's been, but that sort of disguises what's going on within the different property types, where industrial has kept going up every quarter, whereas retail has been going down every quarter, and they sort of offset each other to keep the total or the average of all the property types pretty steady. But you know, we have to thank the demand for warehouse space and the Amazons of the world for keeping that index up. Although office is still doing decent at 1.7%. Again, we're back to quarterly unlevered returns. Hotel tends to be pretty volatile from quarter to quarter and very seasonal. And we have a pretty small sample of hotel properties in these institutional funds, so wouldn't make too much out of that. Apartments, 1.5 roughly, if I round off, take us to that 6% annual rate of return for apartments. And then if we look at the returns over time, again, you see the spread between retail really dropping off. It peaked, actually, it had the highest return at one point back around 2015. You see it just edged out industrial there for one quarter, and then just steadily dropping since then, with industrial really hanging on at those higher levels of return. The other property types all pretty much converged around that 6% level in terms of an annual total return. And then we have the cap rates by property type. Perhaps no surprise that retail is now the highest cap rate, kind of a risk premium in those retail returns. Apartments almost always been the lowest. I think just because of the little bit less risk perceived for apartments relative to the other property types and less capex needed for apartments. Office, the next highest cap rate, and so forth. And industrial cap rates did come down and fall below the retail this time. And I expect the retail cap rates, the industrial cap rates, to keep on falling, given the demand that we have for the industrial space, driving up those prices relative to the income. The completions as a percentage of stock is sort of an indication of what's happening on the supply side. So you can see that apartments have the highest percentage of completions, new supply coming online as a percentage of the existing stock, whereas retail is at the lower end. Perhaps no surprise, there not as much new investment in and new supply in retail. And you can see this by decade. And we do have lower levels of supply coming on in recent years, in this case, this past decade, than we've had historically, which is probably one of the reasons that returns are holding up. We just haven't had the supply, a lot of new supply coming in, like certainly we've had sometimes in the past. Some of you may remember, the good old early 1980s, before we had the tax law change that took away a lot of the tax benefits of real estate, and had a recession in the late 80s and early 90s. That was a result of all that new supply coming in that couldn't be absorbed. What you see here, I hadn't looked at this chart in the past that USAA Realty put together, and you can really see the amount of supply that had come in that decade compared to anything since then. Not all, but a lot driven by the tax laws that we had in effect at that time. And then no surprise, the e-commerce has just been a big part of the what's led to the demise of a lot of the retail space, and the need for warehouse space, all related, because for the e-commerce you need that warehouse space. So store closings, pretty high level for 2019, although it was actually slightly higher in 2017 and 2015, even higher, but we still have a lot of stores being closed. And I don't think the 2019 data in this case included those last two quarters, because you just see on the color chart the first two quarters coming in. So I think when the final numbers come in for 2019, it could be quite a bit higher in terms of the number of store closings. So that's all impacted the NOI growth by property type. Industrial, for all the reasons we've been talking about, has the highest NOI growth, whereas retail has the lowest NOI growth, although still positive. The NOI growth is actually still positive on retail. You heard about some major mergers taking place last week with Simon Property Group, and they rescued Forever 21 for us, so we can all stay Forever 21, Jeff. So they certainly see still a demand for bricks and mortar space. And then the vacancy by property type. So office the highest, but notice how office has been coming down since the recession. We've had kind of a steady decline in office space, although we'll see in a minute that absorption is going to be less because of what's happening with WeWorks. industrial, the lowest vacancy. And again, whenever I say industrial, think warehouse space. CapEx, this was put together by Prudential, PGIM, but with NCREIF data. I think I even told them how to do this because they were seeing that there's just a lot more demand for CapEx going into the office properties than we've seen in the past. And so you see that here, the tenant improvements. So tenants demanding more money for TIs, and then for building improvements, which would include some renovation of space, just continuous demand for that new capital coming into the properties to stay competitive. I thought this was interesting, looking at Google search frequency for the term rent control. Just a lot of concerns about how rent control could impact things with some of the new legislation that's happening or being proposed. And so you see more and more people searching the term rent control to try to figure out what's being said about it and what's happening. We don't usually show slides on search frequency, but I thought it was interesting that Costar had put this together that looks at the Google search frequency. A lot of times that can really indicate what people are interested in, you know, whether it's looking at search for rental property, apartments in a given area, or homes in a given area, or search frequency on the coronavirus, where that's happening geographically. And, you know, the Google search frequency can be pretty powerful. This is the absorption taking place, and as I alluded to before, you can see that the WeWork, the orange there, forecast to be nothing. no WeWork absorption being forecast for 2020 and 2021. So they were going gangbusters for a long time there, but was always questioned by some whether that model was going to work as things started to slow down. Probably still makes sense to have some of that type of space as long as it stays in balance. And then the occupancy, notice that it's been the highest in general in the Sun Belt. I don't know if Seattle's a Sun Belt, but San Francisco, and then when you go over to the orange part in the secondary markets, Phoenix, Tampa, Orlando, Miami, those tend to be the areas that have the highest occupancy. Houston being kind of an outlier of all these, I think, due to the what's happening with oil prices. And then the absorption of industrial space. Notice the significant amount that we have, the orange, from the major e-commerce players. The amount of that warehouse space that's absorbed just by the e-commerce. Kind of see here what that demand is from the major e-tailers. So Amazon, of course, on the top in terms of using warehouse space, and followed by Walmart, Home Depot, Target, Macy's, etc. And you can see the size of space that Amazon is using. Notice the increase in the 0 to 250,000 square foot category, which would be that last mile space for the most part, I think. The Amazon Prime Now, you get something delivered in an hour or two in a lot of geographic areas. You know, you need that smaller warehouse space close to people's homes. And so you can see the square foot of space being occupied by the e-commerce users and how that's been increasing, and the percentage of sales that they have as a percent of total retail sales has just been increasing every year. I think we kind of reached a tipping point of the e-commerce really taking off. So with all that background in mind, what do you think will be the best performing sector in 2020? Is it going to continue to be industrial? We've seen some improvements in occupancy for office, could be office. Maybe retail has bottomed out and been oversold, and folks like David Simon, former student, actually know something we don't know. I'm not afraid to buy bricks and mortar space and do some acquisitions. Still going to be demand for apartments.
Quick results on this one, Jeff. Everybody came in heavily in favor of industrial, 58%, multifamily apartments next at 26%, 13 on office, and a few on retail. So a few are with your Simon camp, thinking that
again, again, consistent with what the institutional investors voted. You know, there tends to be with the institutional investors sort of a herd mentality that, you know, we got to do industrial because that's what everybody else is doing. It'll be interesting to see how long that lasts. Can't last forever. Never does it, Jeff? Always, you know.
Always at the close.
Yeah,
absolutely.
Right. But of course, figuring out when it's going to happen is the trick. So kind of a summary. Another new high in market values. And most of you think that, you know, it'll continue at least, you know, for a couple more quarters till, you know, maybe market values come down a little bit. The returns on all the property types remain positive. We just eked out a slightly positive return for retail space. Industrial still has the highest return. Was down slightly from last quarter, but remember, it's way above everything else. So can't really say it's, you know, been bad that it dropped a little bit. Apartment and office did have the greatest increase from the last quarter. Didn't emphasize that before, but in terms of what property type had the biggest jump from what it was last quarter, it was apartment and office properties. Cap rates still remain at all-time low levels. Occupancy continues to be near all-time high levels. We do expect some slower GDP growth in 2020, but no recession, and hopefully improving thereafter from the forecast that we saw from Oxford Economics. 10-year Treasury is likely to remain steady or maybe a slight increase. And then business investment may be weak this year, could have some impact on CapEx and consumer spending. But again, based on the GDP forecast, we don't see any significant downturn, and things improving even after this year. That's all I got, Jeff.
Excellent. We do have question and answer time, so they come on into the question area, pose your questions. Jeff will do his best to respond, or I'll
or the other Jeff. Yeah,
comments for sure. But I mean, certainly the sentiment seems to be tempered a little bit this time around versus the go-go of the past few years and some of the bullishness, just the amount of the capital flow and all of the metrics. So we're starting to see some changes, but still a bias to the upside. One of the questions coming as a surprise to see the drop off in the apartment NPI. Is this due to competition and the supply side, or just lower yield requirements from investors? What do you
I think the lower yield requirements, maybe because they, you know, are putting their emphasis on industrial properties. They just haven't put as much into apartments. But I haven't heard any concerns about investing in apartments.
Are you seeing anything, or was there any discussion on opportunity zones in the?
No, we don't really have any data on that, or haven't looked for any. Back on apartments, one other comment I might make is apartments was the strongest performing sector coming out of the financial crisis, because, you know, of course, people were losing their homes and not qualifying for homes. So I think part of the reason we have the lower returns now is because they were the ones to first have their prices bid up.
Well, that's sort of what you're talking about earlier with the cyclicality. Yeah, the apartments had the run, now the industrial has the run, and
right.
What comes next? But it does tend to move in cycle and in that herd mentality. So if something else becomes hot, it accentuates it. Was there any discussion with regard to election bias one way or the other? Would one election result pose a different outlook for the
No,
market?
I think the country's so divided right now. I think everybody's afraid to sort of bring that topic up.
Yeah.
Because there's clearly, as I listen to people, clearly people that feel very strongly on both sides. Of course, when you listen to certain news networks, they seem to think that some people say the market's going to drop if Democrats win the election. I'm not so sure that's true, but who knows? Yeah, it's dangerous to talk about politics these days, isn't it, Jeff?
That is for sure. We'll stay away from that one. A lot of interest in workforce housing. Was there any sub-market characterization of that? And do you see any outlook for?
Yeah, actually,
Class A.
In previous webinars that I've done, I can remember some of the guest speakers really saying that that's where a lot of the demand is. And we certainly need, in studies I've seen, there's really a need for more workforce housing. And I didn't include any slides on that this time, but yeah, I think that's where the greatest need is right now, is for that workforce housing. It's an affordability issue, and that needs to be addressed.
And are you seeing anything? This is I'm going to sort of paraphrase a question which came in, but there are the gateway city markets that would benchmark against other global gateway cities. And as you mentioned, U.S. interest rate, not only U.S. interest rates are higher, but cap rates are higher. So we have always thought of 5%, 4% as low, but in other parts of the world, 2 and 3% was norm. Are you seeing any sort of bifurcation of pricing in the major deployments of capital versus to the the bread and butter in the market?
There's been a couple academic studies. I shouldn't say academic, it was done by an academic, but pretty applied, where they looked at the performance historically using the NCREIF data of the gateway cities, or another way they looked at it is the 24-hour cities, which is pretty much the same cities, except like a Las Vegas would of course be a 24-hour city. And they've always outperformed everything else. And the US has tended to outperform. We actually looked at some data recently on indices for the US compared to the indices that they have for funds in the UK and in Asia. And the US in recent years has been outperforming.
It's playing catch up because it's perennially, it was a huge spread, and now that seems to be tightening.
Right.
And I guess it's more of a demographic type of question. And again, I don't know, you're not a demographer or economist, but you may have some perspective on the changes in the movement of millennials into the workforce and the baby boomers into retirement, and how that is impacting different parts of the market, or the residential or the actual occupancy side on space use.
Yeah, I don't have any statistics on that, but I think it's one of the reasons we're seeing the Sun Belts, doing well. And what I hear about is not quite answering your question, but people moving out of the areas that have now impacted by these higher property taxes, and not being able to deduct on your taxes. They're moving from California to areas like Portland. I can see if I can dig into that a little bit for the next webinar.
That's great. Looks like that is what we've got. We appreciate you, Jeff, as always, and the insight into the market. We certainly appreciate all of the RealNex community that have joined us today. For those of you who are using our platform, we appreciate it. For those of you who have not yet enjoyed it, It's an incredible solution set for the industry, from CRM to valuation to marketing and marketplace. Please come take a look and take advantage of all that we have to offer. We look forward to sharing more with you in the coming months. Next month, we'll have Glenn Muller joining us, and follow up with a series of webinars monthly throughout the year. Jeff will be back next quarter with another pricing index and market outlook. So again, appreciate you and Jeff for your time and insight, and for all of you for joining us this
Sure.
afternoon.
Everybody have a good weekend and stay healthy.
Thank you. Bye-bye.